Hey guys, Joel Frank here, market analyst for YouTrading, and in today's video we're going to be taking a quick look across markets which are, just to sum things up very quickly, not doing very much and actually mostly still closed for end of year celebrations anyway. Let's take a look because we do have currency markets open. Might as well start with euro dollar. You can see it's consolidating here just below 107. About 0.25% lower. Wouldn't read into these moves at all. We're very much still within recent ranges, and it seems as though the upwards trend that has been in play now for a couple of months since late September very much remains in play. We're still above the 21 DMA. We've just had the 50 DMA go above the 200 DMA, or a golden cross, which some people take as a bullish sign. And we've got all the major averages pointing higher. So yeah, this uptrend very much still does look to be in play. And that seems to be the case across a lot of other of these major asset classes as well. I mean, maybe not so much for GBP, which seems to now be, or cable, the exchange rate between the British pound and the US dollar, which seems now to be consolidating either side of the 200 day moving average. What about dollar yen? That's been moving to the south recently as well. Like euro dollar is in an uptrend. Seems as though you could probably make a good argument that dollar yen remains in a downtrend. We did have that recent hawkish surprise from the Bank of Japan. That was this big drop here on the 20th of December. We've got the dollar broadly weakening, with markets increasingly expecting Fed pivot at some point next year. I mean, everyone's talking about a recession next year. We even had the IMF coming out this week and sounding quite bearish on the economy. They were saying, the head of the IMF, and he was saying that you're slowing in the US, Eurozone, and China. So you've got synchronized global slowdown, which some might argue would be a positive for the dollar because of safe haven demand. But if it results in the Fed unwinding all of this tightening it's been doing, or is still planning on doing more of, then that's going to be bearish for the dollar. So that seems to be what's driving markets at the moment. But you can see dollar yen just holding here above those recent lows and holding above 130 for now. Although I would hazard a bet that the direction is going to continue to be down here. US equities, US bonds, major commodities markets all shut. But I mean, we might as well look at crypto, which is modestly on the move. Bitcoin around 16.7K, just below its 21 and 50-day moving averages, and within recent ranges. Nothing to get excited about. And that's broadly indicative of everything that's going on across crypto. Not that much, basically, on the major coins anyway. But we could have some big moves later this week. Let me tell you why. Let's look at this calendar. You can see nothing today, very little tomorrow, apart from OPEC, which will be obviously, as always, interesting for all traders. But then we've got a heavy slate of tier one US economic data that's going to be hitting us hard for the rest of the week, and some very important Eurozone inflation data. But let's go back to talking about the US data. Let's go through it chronologically. ISM manufacturing PMI. We're in contractionary territory now, as in the US manufacturing sector is in recession, basically. That's the implication from this data. So that's an early sign of US weakness. However, you've got JOLTS, job openings data, which is coming out later, or at the same time, actually, that day, which, if it shows 10.1 million job openings in the US at the end of November, that suggests labour demand in the US remains very strong. And that's going to be a key theme next week, that we're still thinking that the US labour market is very strong and probably still inflationary, as in actively pushing back against the Fed's efforts to bring inflation under control. Then on Wednesday, we've got the Fed meeting minutes as well. Remember that the last Fed meeting, if I just go on the S&P 500, you can see the reaction here. On the 14th, was hawkish, and it did result in a big drop in risk assets, because Fed Chair Powell basically trying to talk the hawkish game, trying to play down the idea of rate cuts next year, trying to build up the idea that interest rates can remain at high levels for quite some time because they're still worried about inflation. They haven't seen enough evidence that inflation's coming back yet to the target. So that hawkish message, we're going to get a bit of insight into the discussion of that meeting. And we're going to get to see how hawkish the Fed really is, because some of the other Fed members haven't been as hawkish as Powell recently. I mean, I would think that Powell is more on the hawkish end, probably because he knows that if the Fed starts giving off dovish messages now, you're going to have a big risk asset rally, which potentially is going to stimulate the US economy and make it more difficult for the Fed to meet its inflation goal, basically. Because, you know, if you get 20% rally in stocks, that boosts well, that creates a wealth effect. People are more wealthy in the US economy and they start spending more as a result. It boosts the economy, literally. But anyway, that's going to be a very, very interesting Fed meeting minutes. Then on to Thursday, we've got the ADP monthly estimate, which, you know, it's always interesting, but it's not been the best indicator recently of what the headline payroll number is going to be. Unemployment claims, they've been steadily rising, but still at levels consistent with the healthy labour market, which is what we're still expecting. Then, like I say, Eurozone CPI, we're expecting still around 10%, way above the ECB's goal. ECB talking a big hawkish game recently, in recent months, and probably will continue to do so because when you got inflation numbers like these, you can't really do anything else. On to Friday, Canadian employment data for the loonie traders and US jobs data, which is going to be the main event of the week. We're expecting a slowdown in the monthly pace of job gains to 200K from 263K. Still pretty robust, 200K. We're expecting the labour market to remain at 3.7% unemployment rate, 0.4% month over month average hourly earnings increase, which would be better than last month, but is still above levels that are consistent with 2% inflation. Because really what you want to have 2% inflation is you don't want earnings going up more than about 3%, which is about 0.2% month over month and 0.3% month over month gains. So 0.4 would still be too high. So yeah, we're still talking about a hot labour market. And then later, ISM Services PMI, set to show that the service sector, which is dominant in the US, remains growing, meaning that we're not in a US recession just yet. But like I said earlier, pretty much everyone's talking about how they're expecting a US recession, which may force the Fed's hand later in the year, which the bulls will be hoping can create a bit of upwards momentum in risk assets as the Fed backs away from its aggressively hawkish policy. But yeah, guys, that's pretty much the video. You know, we've got a big week coming up, even though it's a very, very quiet start. Hope you all had a great new year and Christmas celebrations and holidays and all that good stuff. And I will see you all in the next one.